Hey, nice to see you today. I'm Janice. Let's review rental property versus a rental business and how to manage your receipts. To help keep the videos short and to the point, I'll go through the explanations fairly quickly, but you can pause and rewind the video as much as you like. Don't forget to check out the other videos in the library. Now let's get started. There is a difference between rental property and a rental property business. In this video, we'll review the difference and everything you need to know about maintaining good record keeping so that your accounting and tax returns can be error-free and help to avoid such things as audits. Let's start with the difference between a rental property and a rental business. To determine whether your rental income is from property or business, consider the number and types of services you provide for your tenants. In most cases, you are earning an income from your property if you rent space and provide basic services only. Basic services include heat, lights, parking, and laundry facilities. In most cases, if you own a property or two, but it is not your full-time job to run these properties and don't deal with business matters throughout your normal day, then you likely have rental property. Whereas, if you have several properties and you focus most of your attention on its day-to-day operations and possibly having maintenance staff, having a few properties and your primary source of income is from this avenue, then you likely have a rental business. Having a rental property or a rental business are not treated the same. If you have a rental business, then this video is not for you. You need to focus your attention more on the business aspects of things, and there are other videos that would be more in line for you. Understanding the difference, let's now get into what you need to know to get the most credits, all without claiming things that you shouldn't be. As an owner of a rental property or properties that matter, good record keeping is not an option. It's a must. Although it's not likely your full-time job to manage this property, you still must ensure you are ready to have your taxes done and present documents to the CRA should they come knocking. Keeping good records doesn't have to be confusing. We recommend keeping your receipts for your property separate and maybe even separated by tenant or apartment. Not only is this good practice for locating receipts when you need to, but also in having your income tax return completed because your revenue and expenses must be broken down by property. If you have your receipts well at hand and you need to have your income tax return process, it's easy just to provide the group totals versus handing over all your receipts for someone else to tabulate. If you have a good system all year long, then providing those group totals at year end should be simple. If possible, just prepare a simple spreadsheet and give to your tax preparer only the totals, not the receipts, unless they or the CRA asks for them. When I say broken down by group, I'm referring to the types of expenses such as hydro, insurance, repairs, and so on. If you share the rental property with another person such as a spouse, then you both must report the rental activity on your personal tax returns and the necessary schedules must be completed. As I mentioned a moment ago, track everything. In this segment, we will discuss the revenue brought in from the property. This process is simple. Just keep track of all the revenue that you bring in and broken down by property and or apartment. Again, revenue must be reported this way as it's how it's applied on the personal tax returns. In fact, the revenue section is the easiest to review. If you charge HST on any of your revenue, you do not include HST collected from your tenants in your revenue as it's funds collected in trust for the CRA, not taxable income to you. However, most people who have rental properties don't charge HST anyway because either they don't meet the threshold of being required to collect HST or the type of rental income is not HST taxable, such as the renting of an apartment. The tracking of expenses is where most people fail, and those faults develop into questions by your tax preparer or by the CRA and perhaps trigger an audit. Break your expenses down by property and by groups, or another way of putting it, the types of expenses. If you have two properties, both with 2 apartments in each building, you should have 4 columns on your spreadsheet for the 4 hydro accounts. If you have monthly expenses, be sure that you account for 12 charges, 1 for each month, and providing you've had the property for a full year, and the expense exists for the entire year as well. There are generally 2 types of expenses. There are your common expenses such as hydro, insurance, maintenance, property tax, but there is another type of expense, and this is called capital assets. A capital asset is more than your common expenses. They are things like the building itself, the property it sits on. You purchase higher ticket items, and the expectations of these items is so that you are to own it for a longer period. There is a litmus test that we use to determine if you have a common expense or a capital asset. Ask yourself if you are unsure. Does this item cost more than $200 before tax? Does this item replace an existing thing that I have and doesn't increase the value of the property? Did you buy it for your properties? In other words, you didn't buy it to resell to someone else? If you answered yes to all these questions, then you likely have yourself a capital asset. Capital assets must not be grouped in with other expenses. They must be kept separate in their own column in your record keeping and very brief description of the purchase. They are not necessarily expensed in the year they were bought and may be subject to being expenses over time. Now that we know more about rental property versus a rental business, revenue, and the two types of expenses, let's discuss some more examples of what could go under the two types of expenses. Some examples of common assets could be hydro, property tax, insurance, general expenses, furnace oil. Whereas examples of capital assets could resemble new windows and doors, a new roof, the building and land itself, new flooring, paving a parking lot, excavation to the property. Always run the litmus test that I mentioned earlier. If it doesn't pass the test, it's probably a common expense. So there you have it. The more you know, the more you'll be prepared to have accurate bookkeeping, and your tax return will be more accurate as well, thus fending off a possible audit by the CRA. If A1 Bookkeeping Services does your taxes, keep it simple. Reduce your tax preparation fees by ensuring your tallying of receipts is done. It is complete, it is legible. This will help to keep your costs down. If you have good record keeping, it is not necessary to bring in your individual receipts. Hold on to them for 7 years in the case of an audit, as it'll be you that will have to justify your expenditures and revenue if necessary. If you haven't seen the other videos in our library, there is no better time than the present. I'm Janice, and thanks for watching, and see you soon.